disconnected, you may use the webinar ID seen on the screen to reconnect. Let me now turn you over to today's webinar host.
Good afternoon, everyone, and welcome to Sun Life Asset Management Company's Bright Talks entitled Maximizing Your Wealth, the Power of Investing in Equities. I am Julie Tilio, and I will be your host and moderator for this afternoon. Thank you for taking time to join us today as we talk about the prospects of equities market. Today, we bring you a team of experts in equities all across the region. We will be able to hear their insights and their view on the market. And to make sure we are helping you as best as we can, we have a Q&A box to source your questions. Feel free to drop your questions on the topic and we will do our best to answer it at the end of the presentation. We will also have a fireside chat to broaden our discussion today. Also, please stay tuned for important reminders at the end. So to start with, okay, we would like to get the pulse of our participants today. We have a poll question for you, and please do participate by choosing the best answer that fits you. So we can now launch the poll. So as we officially enter summer in the Philippines, we would like to know, what are you into now? Are you doing an out-of-town vacation, visiting places or resorts for leisure, or maybe you're visiting your family, relatives, and friends in other places? Are you splurging or doing revenge shopping? You enjoy malling and probably dining after shopping. Or are you just keeping your money in cash at the moment, just steady? Or maybe you're just taking this market volatility as a chance to invest in markets, okay? So let's give some time for our participants to choose their answers, okay? Can we see the poll? Okay. So the poll is still up, and we can end it in 5, 4, 3, 2, 1. So can we see the answers? Wow. Okay. So this is interesting. Majority, or 42% of our participants today, I'm just keeping my money in cash at the moment. Maybe you're probably waiting for a right timing to enter the market. And then the second highest, 33%, I'm taking this market volatility as a chance to invest in the market. And 22%, I'm doing an out-of-town vacation. Okay, and last 3%, we have somebody, no? We still have others who enjoys shopping. Okay, so thank you for your participation. Let's move on now to our program. So 2022 was the year of triple I for inflation, innovation, and interest rate. So we have seen the global inflation peak at 9% in the third quarter and fell 8.3% during the fourth quarter. And Russia invaded and occupied parts of Ukraine in major escalation of the Russo-Ukrainian war. It brought massive and historic energy shock to the markets. And throughout 2022, the US Central Bank has increased the federal funds interest rate from nearly zero in March 2022 to a range of 4.75 to 5%. And for 2023, we would like to get insights on the following. Is the inflation peaking? Is the banking turmoil finally over? Are we going to see a US recession? Will central banks pause on the rate hikes? So to shed us some light, we have a panel of equity professionals across the region. Allow me to introduce them before I give the virtual floor to our main speaker. All the way from Hong Kong, Sun Life Hong Kong, we have Ms. Juliana Quay. She's the Regional Equity Analyst for Asia. Mr. Ricky Yong, he's the Regional Equity Strategist for Asia. And now may I introduce to you our main speaker. He is the head of Equities Asia for Sun Life Assurance Company of Canada, where he oversees Sun Life's public equities portfolios in Asia. He leads a regional team of 16 equity professionals across the region with investments locally and globally. Prior to joining Sun Life in 2019, He led offshore long-only equity investments for ICBC Credit Suisse Asset Management and co-founded an equity long-short hedge fund, Genesis Capital. He started his career with Morgan Stanley in Hong Kong. He has an MBA from Harvard Business School and a BS in Finance and Accounting from Northeastern University, where he graduated as summa cum laude. So without further ado, let me call on Mr. Jimmy Weng, all the way from Hong Kong. Hi, Jimmy. It's great to have you here. The floor
Hi,
is yours now.
thank you, Julie. Thank you for the warm introductions. And yeah, and thank you all for those who dialed in to listen to our Sunlight View on public equities. So our regional team here, I think Julie mentioned as well, Ricky, Juliana, myself, we wanted to speak with you all today and talk about why we remain positive on Asian equities and how we collaborate with our local teams across the region. So we'll go into China, we'll go into Philippines, and we'll go into overall emerging markets, Asia. So I think, Julie, we could probably kickstart our presentation and also leave some room for Q&A in the end. So I think just to kick off, I'd like us to take a look back over the last 3.5 decades. Really look at every situation where we felt it was an end of the world scenario, right? I think it's always good to reflect back on all the different crises that we've all been through over the last 3.5 decades. I think one that's really refreshed on my mind is 2008. Julie mentioned, I started my career with Morgan Stanley, and 2008 crisis was really one where it was really a domino effect, right? I was with Morgan Stanley, we come to the office, and we would always expect that this was the day, right? Lehman, Merrill Lynch mergers, Morgan Stanley was next, Goldman Sachs. So I think, I would like us to kind of put that into context, right? Every crisis, what was the feeling? What was really the cause of that? And what were some of the government responses? But also, what came out of it? 3 to 5 years down the road, what happened, to the markets after that? So really, when we look at all these different crises, we always think that this is an end of the world. Global financial crisis, one that I really, deeply impacted me because it's a real systemic event. 2011 European sovereign debt crisis, as many of you know about the potential defaults, we all thought that this was the end of the Eurozone. 2020, the COVID-19 pandemic, which we're still sort of living through, and we always felt, when's China going to reopen? How are we going to get through all of these, right? And then finally, now we're really living through the 2022-23 Russia-Ukraine war, regional bank crisis, Credit Suisse rescues, a number of issues that time and time again always come up. So I think, one thing about equity markets that we need to keep in mind is we're always going to have financial crises. This is a norm. There's always going to be risk, and there's always going to be opportunities. But what is very consistent that you can see when you look back on the 3.5 decades here I'm showing you is that there's always a government response and there's always a solution. We always have a will, and there's always an impact that it positively allows us to power through all of these different crises. And so I think, for us, think back to all the different scenarios that we've thought was the end of the world. Think back to what our current situation feels like compared to all those other different financial crises. Think about government responses and solutions, the policy impacts. Currently we see FDIC coming in to step in to help the troubled bank, to provide more confidence in our banking sector. Think about regulators who have forced mergers, right, between other banks as well. And so we're basically, it's really to be determined, right, really what the 3 to 5 year impact overall will be. But again, when we look back to all the different crises, the responses, the solutions, we've always seen that we've come out much stronger, ahead. And I think that's the really key takeaway from all the different financial crises that we've really experienced. So the main thing here we want to probably just show is remain disciplined, remain invested, right, particularly in times of distress and also during periods of financial crises, and expect that there will be government responses and solutions, particularly when there's a requirement for a strong need for that, particularly when there's a systemic risk, right? And so, I think, that's really just to kick us off looking at the past. And now let's take a look at our outlooks and our future. We'll focus on China, we'll talk about Philippines, and then we'll kind of recap on why we're overall quite positive, on the region. So from that, I probably want to hand that over to my regional strategist, Ricky Yeung, who's going to talk about China next.
Thank you, Jimmy. Hello, everyone. I'm Ricky Yeung, the equity strategist from Sun Life based here in Hong Kong. It is really my pleasure to speak with you here today. If we zoom into Asia, right, we believe China reopening will be a key catalyst for Asia ex-Japan equities this year. And it has also been a very hot topic over the last few months as well. So if we look at some of the key economic numbers that just released last week, the Chinese economy has definitely rebounded faster than expected. So first quarter GDP has grown at a rate of 4.5%, which is higher than the 4% forecast by economists. And retail sales had an explosive growth of over 10% in March, which is basically the biggest jump in almost 2 years and more than double what the street has forecast. I think it's fair to say the rebound of Chinese economy was mainly driven by domestic consumption. And if we look at how Chinese stock market performed since we opened, I think December 7 last year, it basically tells us the same story as well. So if we look at the chart at the top right, so where we have been keeping monitoring of different consumption themes in the Chinese stock market, that can benefit from the reopening, including themes like domestic travel, such as like China Airline, domestic hotel groups, and outbound travel themes like Macau gaming, Hong Kong retail, and also some of the domestic consumption themes, such as like amusement and food and beverage companies. We find these companies has been really benefit from the consumption recovery. They have been outperforming the CSI 300 indices quite significantly, with most of them returning double-digit return and outperform the CSI 300 index over 10%. And looking into second half of this year, right, I think we expect the border market will continue to outperform with probably a low to mid-teens upside for the China A-shares market, and we continue to like consumer sector as well. And we also like major e-commerce and tech platform, which have been the lagger, if we compare them to the overall market during the rebound of the last few months, and their valuation remains very attractive as well. And we expect most of the Chinese company this year, their earnings will basically fully recover to pre-COVID level, with actually a double-digit year-over-year growth this year and also next year. So, and with that, I think it is also very important to point out, right, the China reopening is not just about a border reopening, but also it is about reopening alongside a policy reset in private sector towards a more business-friendly and pro-growth environment. So if we look at the table at the top left, right, so it is basically a summary of the pro-growth, pro-private sector messages from President Xi and Premier Li Qiang in the very recent two-section meeting and China Development Forum. So you can see Chinese government have repeatedly emphasized on building a more business-friendly environment for the private sector and also for private entrepreneurs, and also emphasize multiple times on China's policy of reopening to the world. I think the intention is really clear. It is really to boost the market expectation and also confidence. And we actually have seen these narratives have been backed by some of the recent action by the Chinese government as well, such as the reduction of fines on the Ant Financial Group and also the regulatory approval for them to raise capital as well. So it has been the first time they approved such scale of capital raising, I think, throughout the last few years. And even earlier this year, we have also seen like Chinese regulators have approved most of the significant batch mobile games, allowing like tech players like Tencent and NetEase to refill their pipelines. So I think like these series of green lights are key evidence that like Beijing is actually softening its stance on like these tech giant sector, which are basically traditionally a key big growth driver for the economy and also the equity market as well. So I think like with like the strong consumption tailwinds and the favorable policy, overall we remain positive on the Chinese market for this year And I think like with the business activities and outbound travel continue to improve, we believe these will act as a really important catalyst to our overall Asia and Southeast Asia market as well. So I think with that, I'm going to pass the presentation to Juliana to talk more about domestic Philippine markets.
Hi, good afternoon, everyone. Thanks for dialing into the call. My name is Juliana, and I work with Jimmy and Ricky on matters related to equity. I guess specifically for today's session, I'll be covering the Philippines. It has been an interesting year, and if not 4 months so far. But I guess the beauty of equities is there's always up and down, and key is staying in the game. So with that said, as it is, where do we stand? I think from our standpoint, it looks like the risk reward of Philippines equities is looking better. On the macro standpoint, tight fiscal positions, high government debt to GDP, PPPs rollouts are probably some of the things that are worth monitoring, and I guess most investors will be keeping an eye out for. But I guess more importantly, the fundamental reasons, fundamental drivers of consumption, i.e. items such as inflation and the currency strength is showing some sort of signs of stabilization. So if you look at the headline inflation figures recently, it has actually turned downwards, i.e. It has slowed. And I guess the expectation going forward is for this to slow even further, given that the base effect starts kicking in the coming months. If you look at BSP's guidance, I think in their assumption for inflation this year, they expect things to go all the way down to 4% towards year end. And that's against the crude oil price assumption of about $80 to $100 barrel. At the moment, we're still trading below it. And I guess as long as, the war doesn't break out, we would be hopefully on track to sort of for inflation to sort of move towards that direction, which will be positive for consumption. On interest rates, I think the more stable BSP to Fed rate differential should help reduce the volatility. And I think that's also very important, especially for foreign investors' standpoint, in that, a stable peso is good for decision making. And besides that, of course, any chance of appreciation would be positive towards the appeal of your assets, right? Whether from a corporate standpoint or a stock equity standpoint. So yeah, I mean, from those angles, I think things are looking more favorable. But most importantly, of course, I think if you look at the equities valuations for the Philippines, it is actually at very low levels already. It is, I mean, just looking at it on a layman basis, it's at GFC levels, -1 standard deviation to its long-term average. So I think what we really need now is just for sentiments to improve, for people to start taking heed again on the appeal of these stocks, right? The other thing that we are also looking at is the foreign ownership levels. It is at decade lows. So as the narratives for Philippines starts improving with better growth outlook, I guess definitely attention would sort of come back to the Philippines again. So yeah, I think that's my quick view on the Philippines. I'll pass the floor back to Jimmy.
Great, thank you, Juliana and Ricky. So I think to really quickly summarize, right, what we're talking about here is that we're quite optimistic and favorable in emerging markets over developed markets. Asia's developing economies, led by China, is really set for faster growth and moderating inflation this year and also next. I think if you look back in the last 15 years, I think most investors perhaps had a home bias and perhaps looked at US market as more of a safe haven, particularly when a lot of positive monetary and also fiscal policies were very supportive. But if you look at some of the projections for this year, IMF projecting about emerging markets to grow 4% compared to about 1% for the US. Inflation in non-developed countries generally lower than the US and also expected to moderate, while US inflation is quite sticky, impacted more by structural issues, including wages and labor issues. So overall, when we look at its macroeconomic situations, inflations, policies that we talked about, overall, and capping it with valuations that you can see here on the left-hand side, we're actually trading at one of the deepest discounts that we've seen historically versus developed markets. And so this is an opportunity, for us, right? Particularly for emerging markets, Asia equities. We've also seen that developed markets have outperformed, since COVID, and we're expecting that trend to reverse itself out over this year and also next. So our house views, for our Asian economies are roughly a positive 5 to 20%, whereas our views for the developed US market is flat to slightly down. I think that's overall quite consistent with the analysis that we've done across regionally and globally. So I think that's the benefit of having a regional team to really not just look at local analysis and local markets, but putting a wider perspective, looking at some of the key catalysts, looking at some of the other markets and how the performance is done on an absolute and relative basis. And also looking back on the first slide that I mentioned to really kick off this presentation, what has the equity markets done 3 to 5 years out if you maintain discipline throughout the financial crises? So I think that's really where we want to, kind of summarize, all of our views, overall favoring emerging markets over developed markets, some key economies that were quite favorable with some key catalysts, and overall sticking with, our views that, we think the current situation is quite manageable. And so that's why we maintain a more positive view. I think our last slide, if you could turn to the next one, was really just a recap and a dashboard on what we're seeing on earnings. And so if you look back in the fourth quarter and also for first quarter of this year, it's really earnings impact that has been missing the market expectations. And so that's really what's been holding back any type of more positive sentiment, that could really translate into better performances. But overall, we're expecting that to really turn around, especially after 2 negative quarters, right, in terms of surprise magnitudes on earnings. But we do monitor this quite closely across every market, across all the different sectors. And we are looking at more positive, outlooks, particularly when you look at valuations across the markets are trading well below your historical averages, and also inflation expected to peak out and come down, as well as rates to also be moderating. So we're expecting multiples and earnings to recover. And so this is, I think that's pretty much what we want to close with. I think we could probably we have plenty of questions, I'm sure, for the panel, also with Miko and Olan here to talk really about global, local, or regional markets. So I'll hand that back to Julie to kick that off.
Thank you very much, Jimmy, for sharing your views on the market, and to Juliana and Ricky. So it's comprehensive and interesting. So let me give some key takeaways to our viewers. I like what Jimmy said, that there is always risk and opportunity. There is response and solutions, and at the end, we come out much stronger. Okay, so that's I like that. And when investing, we have to look beyond 2023. The stars are aligning. So we have heard Ricky said, all data right now from China are faster than what's expected. And then, especially for emerging markets, outperformance. And we have a good story on China reopening, attractive valuations for emerging markets. And emerging markets, especially China, Asia, may outperform the developed markets. And it's telling us that this can be a good time to position for a rebound. A down market or cheaper valuation simply provides long-term investors to make their investments at lower prices. Always diversify. This is the easiest and the best strategy at all times. If you are concerned about downturns, the key is to diversify. The different asset classes tend to perform differently under various market conditions due to their unique characteristics or relationships. So by combining different asset classes, the risks and performance are summed up, thus lowering overall portfolio risk and gives you opportunity to maximize investment returns. And get invested, stay invested. The key is to stay the game from Juliana. Stay the course, stay focused on long-term strategies. Over a period of many years or even decades, investors have the opportunity to ride out these highs and lows to generate a better long-term return. Once you've built a well-diversified portfolio suited to your goals, time horizon, and risk tolerance, staying invested through all the market conditions is a time-tested strategy for achieving investment success. Okay, so now let's move on to the fireside chat. Steamy, Jimmy, Juliana, Ricky, please stay with us. And now may I call on our panelists, other panelists from the Philippines. Our very own Mr. Miko Vergara. He is our head of global funds in the Philippines, and Mr. Olan Caparina, our equity portfolio manager in the Philippines. So let's start the ball rolling. I have prepared here some questions about what's on the mind of our investors. So the first question, okay, what is the potential driver for economic growth in Asian equities? Okay, let's hear it from Jimmy for Asian Outlook and Nico for Global.
Yeah, thanks for that, Julie. I mean, it's a great question. You know, when given where I'm sitting and looking across all the different markets across Asia, you know, I see that there are different catalysts that would really trigger and be the potential driver for economic growth. You look at Indonesia, where a second half there's potential fiscal stimulus because of it's an election year. You look at China, which is basically reopening and all the different positive signals supporting the private sector as well as the tech sector. You look at overall, this is going to be a year that there's going to be a growth recovery as a result of economies pulling out, of COVID, and also looking at inflation coming down. And I think that that's really going to be a major trigger, leaving much more room on the policy, both fiscal and monetary, to really stimulate consumption demand. And I think that's going to be a real driver for economic growth across Asia, particularly when it's going to be focusing less on exports and more on domestic consumptions.
Thank you, Jimmy. Would you like to add, Mika?
Yeah, so a lot of good points covered from Jimmy and the team's slides a while ago. Maybe for me, flows are really a big deal here in our part of the world. So outside of the long onlys or the institutional fund managers, local markets do rely on in a big way, in terms of people coming in. So you have US investors, European investors coming into local markets and then propping up prices. One thing I've noted though, if you track ETF flows, so we've seen that already. So if you look at Greater China, so when we say Greater China, this includes Taiwan, this includes Hong Kong, Macau to an extent. Flows into that market were 10% of total net ETF assets. So we have seen investors coming into the region, albeit selectively. So another market that I'm seeing has absorbed a lot of ETF inflows would be Thailand and Vietnam. So on average, both absorbed about 8% of total net ETF assets. So can you imagine 8% of your total assets flow-wise coming in and buying those asset classes? So we're not really saying flows haven't come in. They already have come into the region, into select markets. Maybe the other thing I want to highlight, for people to really appreciate our part of the world, our region, there needs to be a difference or an upside in terms of earnings. So for ACWI, Jimmy and the team really put it well, no? So North America, they're having some problems. People are expecting a recession to come along that part of the world. If you look at broader equity index earnings, it should be about 1% for this year. But if you look at our part of the world, Asia ex Japan, it should be, forecasts are looking at about 6%. So 6% for Asia ex Japan, 1% for ACWI or the Global Equity Index, and then compare, So where else can investors get that sort of premium, at least earning side of it, So that's something I think that's something investors should look at, and that's something that should motivate people to, rethink their allocations, at least regionally, and hopefully they can position towards us given that differential.
Thank you very much, Miko and Jimmy. That was well explained. Okay, now let's go to the second question. Here, now we talk about China reopening. Okay, so what will the China reopening mean to the global equities market?
Well, for me, there's two parts. The Chinese tourists are really out for revenge spending, and so we've seen that a lot where I'm based here in Hong Kong. A lot of the brand names, you see that Macau is also doing quite well with crowds coming in. So overall, that's the first part. I think that's a direct impact on China reopening, the tourists across Southeast Asia for Hong Kong and also globally. I think the second part of that is the support on global GDP. All right. I think the reopening really triggered the domestic demand as well. So we're also going to be expecting an influx of imports from all the different economies. I think Southeast Asia, and including Philippines particularly, is really a main beneficiary of that, really from an export angle, but also from an influx of tourism. So I think that as reopening picks up, I think that's going to carry over to next year. We should expect to see more positive economic activity.
Thank you, Jimmy. Would you like to add something again, Miko, for the global view?
Yeah, so people can, people like assets within their portfolio. Like, people like to diversify. So if we're talking about China, for global investors, you don't have to buy China to play China. So if you think about it, who is one of the major trade partners of China, in general? So that would be the Eurozone, no, to different degrees. So there's services, there's tourism. So Europe benefits from China reopening. So like Jimmy said, revenge traveling, it's back. So if you look at who's been doing well, no, year to date or over the past 12 months, who's been really doing well price-wise in terms of their assets, Europe's been one. You look at Taiwan, Taiwan's been another thing. So the commonality between Europe, Taiwan, and some other parts of Asia, these guys are part of the Chinese value chain. So if people are a bit jittery of buying direct China, you could buy that second level of assets, that second derivative of assets, which is a play on that thing you like. So I like Chinese tourism. I don't have to buy Chinese airlines. I don't have to buy Asian airlines. I can buy companies in Europe which I know have high impact or have high play with that China tourism story. So there's always that second layer of assets you can buy to play on an investment team.
Okay, thank you. So it's really China, no? So China's 2022 was a momentous year of lockdown, and today the story of the reopening brightens the 2023. So I like that. Thank you for your inputs. And to continue our third question, how big of an impact is the China reopening in terms of Asian equities? Do you think Asian equities will really outperform developed markets this year?
Yeah, Julie. So I think just continuing on this topic, if you look back on the slide that I showed, emerging markets is trading now at a record discount versus developed markets. All right, and so that's really where our outlooks are more positive on Asian equities versus developed markets, U.S. equities particularly. If you look back on some of the macro indicators that we mentioned, we talked about inflation, we talked about rates, we talked about earnings, we talked about growth. That's really where the inflection point really, because valuation is actually at the record low, but what you need is the catalyst. So what is that catalyst? It goes back to your first question. What's the driver for Asian equities? And that becomes the policy shift. China is now turning much more positive towards its tech industry, towards trade, towards private enterprises. And I think that positive message really leads to more positive policy, both on the fiscal and also on the monetary side. And that will spur more domestic demand, and that would improve the GDP growth locally. Whereas I think in developed markets, there's probably other concerns and issues that we're not seeing particularly priced in, that we are experiencing more in Asia.
Okay, thank you, Jimmy. To continue with China, we have one question here from our participants. What are your thoughts on the geopolitical tension between China and Taiwan, and how does it affect the global and Philippine market?
I'll take this question, and feel free to chime in, the rest of the panel. So the geopolitical tension is it's between China, Taiwan, and also the U.S. I should bring that in. This should really be framed as U.S.-China tensions, and it's really been ongoing for the past few years. We started with a trade war that translated into a tech war, which translates now into more of a territorial policy, war. The risk is a miscalculation or an accidental conflict, in my opinion. Great powers would not purposely look for conflict. They look for ways to work around that. And I think that's really where Congress, in the US and also the Central Party in China are really trying to get towards. Now, it's really the miscalculation that would basically trigger what I would call a low probability but high impact event. That's really how I would see the effect on global and particularly for Philippine markets, like Miko mentioned earlier. These fundamentals that we talked a lot about, it's positive outlook. These are great, valuations are cheap, but what's your catalyst? There's an overhang on tensions that is prohibiting or preventing foreign flows from entering into risk markets, and that includes Southeast Asia, Philippines. But I think as we're basically getting more clarity, more conversations, and more discussions around meetings and trying to really calm the situation a little bit better, we would probably see more stable inflows, particularly for Southeast Asia going forward. But I agree that this is probably a tension that has been ongoing for the past few years that's led to underperformance in these markets. But we do see that this is more of a low probability, high impact event rather than one that I would be pricing into our base case.
Okay, thank you very much, Jimmy, for that. Now let's move on to our next question, please, for our fireside chat. For number 4, how have our regional clients across Asia been reacting or investing given the recent concerns in the banking sector?
Yeah, so this is a question that I get quite a lot, specifically across the region. But one thing I really want to really try to take a step back and maybe really clarify that the impact of what we've seen is quite limited in Asia. Very few banks, in the region have direct exposure to the 3 big bank failures that we've seen in the US and Europe. And really, we've seen sufficient capital in the Asian banks. And so there's really very limited vulnerabilities, as well as more aggressive stances from regulators, right? I think that most of that has really been contained within US and Europe. And I think that we've also seen the worst of that, particularly now. Now, if we want to go kind of look further out, the ripple effects, right? We talk about Credit Suisse, we talk about Deutsche Bank, what's next? I've been through 08 crisis, so really been there in terms of a crisis of confidence. That is really among the depositors, right? Despite healthy looking metrics upon, Credit Suisse and Deutsche Bank, you look at both businesses, the financials were actually quite sound, right? You look at improving profitability, diversification of business lines, capitalized ratios. But overall, it was really just the markets having a fear for the weakest link in an overstressed market. And that's really where the FDIC and regulators really came in to really put a stop to that, to really provide a backstop and comfort that their deposits were well protected. But overall in Asia, we've actually seen very limited impact and very limited exposure. So we've taken this as an opportunity for us to actually increase our exposures because we see this as another, what I call opportunity during these risk events.
Okay, thank you, Jimmy. So financials are quite sound, and it's only the fear that's it's holding on our investors. Now let me move on to the next question. It's still on the banking sector. Do you think the banking turmoil is over? Have our portfolios been trimming down exposures to financial stocks given the stress on banking stocks, or do we load up on them given how cheap they are right now?
Hello. Yeah. Hi,
Yes,
Julie. Let me take that question.
Yes.
Yeah. In terms of the impact on the Philippine banks of this U.S. banking turmoil, I guess this happens once in a while. Like before, we had the GFC or global financial crisis, which is a larger scale in terms of banking crisis. And right now, we're seeing some snippets of weakness in terms of U.S. regional banks. So I think it boils down to the risk management of the banking sector. So there could be some gap in terms of risk management, especially on the U.S. regional banks. But if you're going to look at the Philippine banks, I think they're more stable. In fact, in terms of our exposure to the U.S. regional banks, we don't have exposure in terms of the Philippine banks having exposure to the U.S. regional banks. So they have limited exposure. I think most of them just have like deposits in Credit Suisse, and in terms of exposure, it's like less than 25 basis points of their total book value. So that's very negligible. So we should remember that this banking turmoil can happen anytime, even in the future. But in terms of our strategy on the Philippine banks, actually we are overweight on the banking sector. That's one of the sectors that we have been bullish on starting last year. we know that inflation has been rising and interest rates would remain elevated. So banks can lend at a higher rate, so they're getting higher NIMs because they can lend high and then they borrow at a low level of interest rate or CASA deposit rate. So for now, we have actually remained overweight on the banking stocks. We like the big banks because we know that they are very stable in terms of how they manage risk. We don't have exposure on the smaller names because of liquidity concerns also. So just to finish this question, we are bullish on banks, and we don't think that Philippine banks would be significantly impacted by what's happening in the US.
Thank you very much, Olan. No, so the Philippine bank is more stable, and at the same time, we have no exposure, limited exposure to the global banks. And then we prefer banks. No, we like banks right now because they're benefiting on the high interest rates in terms of doing their loan business and getting the spread from their clients. So thank you for that. Now let's move on to the next question. So with regards to the Fed's next move, okay, if the Fed will eventually pause on the rate hikes and maybe pivot to cutting rates, will this be a cue for a meaningful rebound in the market? So your thoughts, Miko?
Yeah, thanks, Julie. So Fed cutting rates. So I think let's put it this way, So if you think about 2022, what was the primary driver for equities really moving down? It's because rates moved up, so people could just invest in a bond, a very, very safe, investment, right? And benefit from higher yields. So if your equities don't give you something sort of a premium above that, there's no incentive because it's riskier. So people tended to sell down their equities, buy TDs, buy the bond that they like, and benefit from that. In this case, it's the opposite. If the Fed does cut, so incrementally rates should move down, not in a month, not very quickly, but rates will adjust. Even new bonds will be adjusting to the current or the newer market levels, in terms of yields. And what will happen then? Equities should be able to retain some attractiveness in that case, So just looking back at the numbers, 2022 PEs, or the price to earnings multiple for equities, all went down, diba? So when rates move up, PEs move down. So if you think about it, what sector was hurt the most, or whose PE was compressed the most when rates moved up, to over 5%? So I'm looking at the numbers. NASDAQ, or information technology sector, or the IT sector, one of the prominent IT equity indices in the US, its PE collapsed or declined by 34% last year on that move. What about the S&P? The S&P's PE compressed by 30%. If you look at Europe, its PE compressed by 34%. What about Asia? Asia ex Japan, our PE compressed by 15%. So it's not as big as what happened in developed markets, but it's also because Asian banks, Asian CBs didn't raise rates as much, diba? So that's one thing to think about. One reason explaining why equities corrected was because the multiples had to correct outside of their earnings compressing. So if you have the factor pressuring that rolling off, i.e. Fed cutting rates eventually, the PE should be able to expand to a degree, assuming that there's earnings to back it up. So our team, we don't like buying markets because their PEs have fallen. There has to be some earnings to complement that. So we can't just be buying something because it's cheap. So I guess in summary, if the Fed does pause at a certain point, certain markets who have earnings backing up their growth stories may see their PEs expand by more, because risk-free rates will be moving down as well.
Thank you for that, Nico. So since you talked about NASDAQ, so let's move on to the next question. Let's touch on the tech sectors now. Okay, so we've seen the tech sectors correct last year, but this year we're seeing tech sectors rebound, with the Nasdaq up by 15% year to date. Is the big tech back, and that the rally can continue? Are we bullish on tech in Asia as well? Maybe Nico and Jimmy can give your thoughts on this.
Jimmy, you want to go ahead? I'm happy to chime in afterwards.
No, you just continue your story, Nasdaq, and I'll add to it.
Okay, sure. So I think on that, no. So this year, Julie, earnings for Nasdaq should be coming out at around 3%. So think about it. Nasdaq up 15%, earnings is only 3%, diba? So the bulk of that will be coming from the PE or the multiple expansion. So is that a fair sort of relationship? One thing I'm thinking about, people could be positioning early in advance of the Fed pausing and cutting rates. They could be positioning early for next year's earnings. So since this year's earnings for Nasdaq is only about 3%, compared to it's about 10% for the past 10 years, next year earnings should be around 17%. So it's more above trend. So that could be one of the reasons why people are positioning early. So to that degree, it has to be the Fed is consistent in what they want to do, i.e. pause and then cut rates. That should maybe give some room for the Nasdaq to move up higher, on position taking by investors. Maybe one other distinction for investors to think about the tech sector, you got to think about, are you in the software part of it? Are you buying hardware? So in the pandemic, what was one thing that local companies, and I'm sure other companies within the region were doing? They were supplying their employees work from home equipment, diba? So they had to supply laptops. People had to bump up routers to take on higher internet speeds. So that's a hardware sort of story, So what you would buy in that situation wouldn't be a broad tech thing, You would want to buy something which supplies hardware or is part of a hardware value chain. I wouldn't really be thinking about, commerce or other software type things. So there's different ways to play it. I think investors need to know what the theme they want to play on is specifically, and buy the thing which works with that. So it's not I like tech, I'll buy something. It has to be a certain part of the value chain within technology, and you need to know what the drivers are to keep that story going, to make it sustainable, at least for us to be able to invest in it. Jimmy, any other things you want to add on?
Yeah, so I agree with looking at earnings yield, right, against rates, right? This is really just looking at what's more attractive, right, in the market right now. If you're able to get a better, yield on fixed income or other asset classes, then perhaps, your earnings yield in equities is less attractive and you see outflows in the asset class, right? So your multiple story, I completely agree. There's going to be expansion and contraction depending on what the rates are. I think one thing to probably, kind of put out there as well, though, is I think a rate cut is not definitive, and it doesn't really translate directly into a positive market reaction. Let's just take SVB, for example. Last quarter, there was some expectations that the Fed may cut rates as a result of the banking sector crisis. Now, if that happened, there may actually be a reverse in market reaction. There may actually be a concern that it's something that the Fed is seeing that the market is not seeing, so we may actually sell first. So I think when we're saying that there's an expectation that the Fed may cut rates later this year, it's really to support the economy. But if the Fed is cutting rates as a result of a distress or financial crisis situation, that actually would have a direct impact on earnings in the future. And I think equity investors would actually de-risk as a result of that. But as of right now, as you see here, overall tech sector rebounding, Nasdaq up 15%. Overall, there's an expectation that the Fed is supporting, right, the overall sector. Nasdaq tech overall is synonymous with growth overall, as a sector. And so I think, that's really more supportive as a result of peaking rates and peaking inflation in the US.
So thank you very much, Miko and Jimmy. So now let's move on to another topic. So let's touch this time for the Philippines. Okay, so our number 8 fireside chat question. In one of our slides, we have shown that the foreign ownership in the Philippine stocks is at the decade low. So what do you think will be the major catalyst to drive the foreign investors back to buying the Philippine stocks? I'd like to hear your thoughts also, Jimmy, for a regional point of view, and also Olan for the local view.
Yeah, I think it'll be very interesting to kind of get perspective both locally, local and offshore. So, in my role, regional, head of equities, we're managing equities in many different Asian markets, Hong Kong, Singapore, Indonesia. We're all looking at opportunities, and we always look at Philippines as, you know, a market that potentially is one where we want to actually allocate more into. I think in order for the other markets to be attracted to Philippines, or perhaps, you know, deploy more money into it, really comes down to really a few key factors. One is the FX. Do we believe that the currency has stabilized, and so there would be, you know, perhaps positive FX impacts as a result of translating from US dollar into the local peso? And the second is the liquidity. Really, if we're looking to invest in the Philippines, it's not just going to be a minimal amount. We want this to be an impactful investment. And so we would like to have a sizable impact that we could both enter and exit, you know, from as well. So it's a two-way investment, you know, particularly when we're investing long-term, but overall, we want to make sure that it's an investment that we see as a long-term growth, one that is sufficient liquidity to drive that and has positive FX impacts from a foreign investor perspective.
Okay, thank you. Thank you, Jimmy. How about Olan for local view?
Yeah, in terms of the Philippine market, I think the main concern since last year was higher inflation. So if we see, like, in terms of macro, we see lower inflation going forward and interest rates would decline, that could be a positive for equities, assuming that earnings would still continue to grow. No? I agree with Jimmy, like in terms of liquidity, it has been a challenge for Philippine equities. We know that foreign investors prefer bigger markets because they can buy in and out of their position from those markets. Unfortunately, we've seen like decline in terms of weighting on the MSCI index for Philippine stocks. So that has contributed to the outflows for the past few years. And hopefully, if there could be new issuances or IPOs that are big enough for foreign investors to get into, so that will be a welcome development. But for now, I think an improving macro scenario or lower inflation, stable peso, and at the same time improved liquidity, we can expect foreign investors to come back if those things happen. Thank you.
Thank you very much, Olan. So now let's go to the question number 9. Okay, so I'd like to pick up also a question from the Q&A. I'd like to connect it with our number 9 Farside question. For clients who are down in their equity funds, what can you advise? Sell, hold, cost average now? And the question from our Q&A, we have been hearing positive outlook since 2021 about the reopening of economies, etc. How come it has not translated to positive growth or performance in the Philippine stock market?
Well, let me answer this question first in terms of buy, sell, or hold. I would suggest that we buy Philippine equities, considering that we're trading at 12.5 times PE, which Juliana mentioned is already at GFC level. And if you're going to look at the pandemic level during 2020, the market went down to as low as 4,000 in one day, and it hit a PE of around 11 times. So we're already there. So I think in terms of risk reward, Jimmy has already mentioned it has been favorable. If you're looking at equity yield to bond yield, equity yield is around 8% versus bond yield of around 4.5%. You're going to take out the taxes. So there's some attractiveness in terms of investing in equities. But it should be looked at as a long-term investment. As Patrick noticed, during 2020, we were saying that the reopening story would be positive for the market. But unfortunately, it hasn't translated into returns. But looking at the performance of the index, we saw the index went out as low as 4,000, and right now it's trading at 6,400. And if you're going to look at the past few quarters, it has been very volatile. So there are snippets of opportunities that we can see. So considering the valuation as of now is at 12.5 times, and we went as high as around 18 times, so actually 21 times when we reached the 8,000 level. So given this, we think that we should be invested in Philippine equities and take this as an opportunity to load up on the portfolio. And yes, it could be flat like for the past 2 years, but there are snippets of uptrend that we saw. Like the index can gain like 20% in 1 quarter. So we should be watchful on that. And considering, as I've mentioned, like PE now is around 12.5 times. I think it's a good time to go into Philippine equities.
Okay, so thank you very much. So there's a lot of opportunities in our local market. So now let's go down to our last question. Okay, for number 10, for young investors who are aggressive, what kind of asset allocation would you recommend and what funds would be good at this time? Jimmy, from a regional perspective?
Yeah, so both I'll take a long and short term, perspective here. For young investor, obviously taking a long term perspective, you're willing to, or you're able to really handle the volatility of the markets. But overall, we're seeing long term earnings growth. Philippines actually is one of the few markets we're actually seeing earnings being revised upward, not downward. And so I think over the long term, equities as an overweight in your asset allocation portfolio makes a lot of sense. Earnings continue to grow. I think, what we talked about in this panel is whether it looks attractive relative to bonds or other asset classes within the shorter or medium term. But over the long term, your return expectations should look quite attractive. But I think on the second part of it, which funds would you recommend at this time is really more of a short-term question. Given where rates are and also where the yields are basically providing you, this is really what goes back to why hasn't equities basically performed or delivered this outperformance that we're really looking forward to because of the reopening. It's really because, like we talked about earnings yields, it's not as attractive. And that's really because bond yields are actually, and rates are still high. Inflation is still it's setting to peak and coming down. So I think, a product where you are able to get high and stable coupons and yields with potential equity option upside is perhaps, one of the best strategies or fund structures that you could probably be looking at right now in the current market environment.
Thank you very much, Jimmy. So it's been a meaningful discussion, with you, Jimmy, Olan, and Miko. So for those unanswered questions in our Q&A box, due to time constraints, rest assured that we will take a look at it and try to answer via chat, or we'll get in touch with you through your contact details in the registration. So thank you once again to our speakers and panelists. So to continue, here are some bright tips to help you in your investment journey. So B, for building the right portfolio. So the key is to build a right portfolio that can help you sleep sound at night and keep you comfortable as the market twists and turns. Our financial advisors can help you identify your risk tolerance and can offer advice on which asset allocation may best fit your profile. These are our model portfolio for conservative, balanced, and aggressive investors. Our asset allocations are spread throughout money market fund, bond fund, balance fund, and aggressive fund. To help manage volatility, consider whether your stock and bond mix matches your tolerance for risk and consider adding assets that may offer inflation protection. R, for the next slide, okay, is to reassess your risk profile and reallocate. If you're just holding a one fund, just like in our illustration, we advise you to be open to rebalancing portfolios as inflation and interest rates normalize. You may want to consider shifting some to bonds, local equities, and global equities. And if you are concerned about how long it will take to recover from severe stock market losses, balance your portfolio with bonds. Bonds act as portfolio stabilizer. It meant to shield your overall portfolio from further risks, and having a sound and strategic asset allocation with regular rebalancing is important to manage risk and maintain your desired asset allocation. And I, for invest via cost averaging. Fortunes are built over time, so investors should stay disciplined. For many investors, this discipline involves adding money to the market regularly using a process called cost averaging, which helps you avoid the risk of investing a lump sum at a wrong time. And next, for G, to invest for growth and value. This is a great time to be investing as valuations have come down to a more reasonable levels. History shows that financial markets tend to go up in the long run despite short-term fluctuations. Market corrections have created new opportunities for investors. One, to review. Two, to rebalance your portfolios based on your investment objectives. And H, have a plan. Okay, having a personal financial plan provides direction and meaning to one's financial decision. This includes review of your finances, setting investment goals, time horizons, like building up a college educational fund for your child, or maybe preparing for your retirement. And last, it's T for time in the market, over timing the market. Returns tend to be better over the long term. Okay, so sharing with you, here are our equity-laced, actively managed fund. This will provide you opportunities to position for a potential rebound in the equities market. The local equity fund invests in the top corporations in the Philippines, namely SM, BDO, Ayala, BPI, Metrobank, ITC, SI, URC, and more. And for your global access, we have the World Voyager Fund. It is a fund of funds and gives you access to big names like Netflix, Amazon, Google, Meta, and so much more. This can be a good alternative for your dollar placements. And coming soon, we will have the Peso Voyager Feeder Fund. The Peso Voyager is a feeder fund that will invest at least 90% of its net assets in its target fund, the World Voyager Fund. While the World Voyager Fund is is a dollar-denominated fund, the Peso Voyager Feeder Fund accepts investments in Philippine peso. So you don't have to worry about the currency conversions. And this gives you access to global equities using your Philippine pesos. Okay. Now, in my next slide, an important reminders to our investors. We have new guidelines to provide you a faster, safer, and more secure credit to account fund redemptions. Okay, effective April 1 this year, this credit to account will provide our investors smooth redemption process, and most of all, ensure safety when crediting redemption proceeds to your settlement bank account. There are 3 ways to enroll your settlement bank account. First, when you open an investment. Second, when you make a redemption. Third, upon demand anytime at your convenience. Okay, so the first option when opening an account, in my next slide, you just have to submit a clear copy of your proof of bank account or PBAU with your valid ID. This can be done via over-the-counter or via emailing scanned copies to request slamc@sunlife.com. Second, when you make a redemption request, all you have to do is prepare a proof of bank account and a valid ID. You can submit documents through our client service center, or you can do it using our client portal or mobile app. Under proceeds for mobile app or redemption options for client portal, fill up the settlement bank account details and upload your proof of bank account. This will all be finalized upon input of a one-time PIN for verification. And after that, you will receive an email confirmation or order ticket number. Okay, so finally, upon demand, at your convenient time, you can also download our form from the website sunlifefunds.com. Under downloadable forms, the settlement bank account enrollment form, and submit together with your proof of bank account and the valid ID. You can submit it again over the counter through the client service centers nearest you or via email at slamc@sunlife.com. So for more inquiries, contact us through our client care at 88499888 or sunlink@sunlife.com. So as we conclude today's event, we would like to thank our speaker, Jimmy Weng, together with the panelists, Juliana, Ricky, Miko, and Olan. And to all our valued clients and Sun Life advisors, thank you for your time and attention. So we will be sharing the key takeaways and recording link through your email. This webinar is brought to you by Sun Life Asset Management Company. Again, this is Julie Tilio, wishing everyone a pleasant afternoon.